Commodity prices have been in decline over the past year, but that doesn't mean you should pull them from your portfolio, says my next guest, Ashmead Pringle. Welcome, Ashmead.
Thank you, Greg.
All right, corn, cotton, soybeans, certainly gold and silver have been falling over the past year. So why should investors stick with the hard goods?
Well, it depends on what your reason for allocating to commodities is, Greg, and I think there are several good reasons. One is inflation hedging, one is dollar hedging, one's emerging markets. Another is simply an allocation to an uncorrelated asset class that tends to do well when stocks and bonds do not.
Well, people really rushed into the hard goods because they were worried about inflation. They figured if the Fed was pumping all this money into the economy, it's going to end up somewhere. That really hasn't happened. What's your view? Will we start seeing higher prices in these goods, perhaps by the end of the year, maybe next year, when this money finally is seen in the system?
Well, I think we will see some higher prices. I'm not sure because of that money, although the recent peak was in April 11 when QE2 was really going on, and since then we've really been declining. But I think the bigger story is longer term, one of growing demand for commodities worldwide from higher GDP, population growth and the like, against some constraints on the supply side, particularly in agriculture.
Well, more immediately, we've been getting slower economic news from China. Their imports are going down. People are talking about maybe even a 6 handle on their GDP. How will this affect the commodity markets?
Well, the slower China grows, certainly the less commodity demand there is. But I think it's worth thinking about their growth absolutely. If they do grow at 7% or 7.5% this year, since they doubled in the last 8 or 10 years, that's 15% in terms of commodity demand, the same as 15% 10 years ago. So their growth may slow, but their commodity demand could still rise. And we think it's not just China, but India and Asia Pacific as well, over the longer haul. Driven by 2 billion more people coming to dinner on the planet in the next 20 years, and by the rising of about 3 billion into a middle class.
Well, as commodity prices have come down, a lot of people have left the sector, the hot money is gone. Are we back to fundamentals now? Where are the fundamentals for commodities? And is this good for the sector ultimately?
Well, I think it is. I mean, commodities in other markets always are going to have corrections, and the fundamentals are different for the different commodities.
But did it get blown up too much when we were seeing commercials about gold every day on the TV?
Well, I think so. Gold is really a different case, I think, than most. It's more of a currency, and gold has a mystical allure, among other things, though not much utility. So I think gold probably got overdone.
So your ETF, the GreenHaven Group's ETF, the ticker is GCC. So how is that different from other ETFs in the market?
Well, it's in the index that it tracks, basically. The other indexes in this space, or the other funds in this space, track indexes of their own construction. We track the old Thomson Reuters CRB, which is equal weight and is low in energy. The others are all much higher in energy and therefore have more correlation with those markets and more volatility.
And it's equal weight into things like corn and soybeans and cotton. Which of these assets do you think will do the best over the coming year?
Well, if I had to pick one in the ones that we track, Greg, I'd say it'd be sugar. I think sugar will probably do the best over the next 12 months.
All right. Thanks a lot, Ashmead.
You bet, Greg.
And thank you for watching The Street.